Before we get started, I want to remind everyone that the information in this presentation is not to be or construed as investment advice. The information presented are subject to change without notice, and while we have made every reasonable effort to ensure that the content is reliable and accurate, we have not independently verified the content and are not responsible for errors therein. Please consult a professional advisor before putting a loonie in any of these financial markets. Hi everyone, my name is Richard Diaz and welcome back to the IceCap Canadian Market Wrap. Over the last month or so, I've watched with amusement and some frustration as the narrative around Canada and its economy has shifted. A potential trade war with the US and tit-for-tat tariffs now dominate headlines. Canadians are right to be concerned. No one likes uncertainty. However, over the last few days, it has reached a fever pitch, and the panic and the rhetoric now seem unjustified and unproductive. In short, it has become a distraction from the underlying problems that plague Canada. In our view, this is due to some clever politicking from the federal government, taking the famous Winston Churchill quote to heart, with the jingoistic media complicit in the con. This type of sleight of hand is not new, of course. Throughout history, political leaders have leaned on external enemies, real or imagined, to distract from domestic problems. Facing difficulties at home, such as economic crisis, political instability, or social unrest, leaders have exaggerated and amplified external threats to unify the population, consolidate power, and or to divert attention away from their internal failures or a poor record. Rather than addressing these failures, they have focused on blaming foreign adversaries to rally nationalistic sentiment. In this week's episode, we're not going to fall for that trap. Instead, we'll review the economic issues that Canada faces, issues that were manifest long before the Trump tariff threat, and will remain once the dust settles from this fracas. Finally, at the end of the video, we will take time to address some of the negative outcomes from a prolonged trade war. And so let's get started. In last week's episode, we discussed how and why Canada still faces a housing crisis and at what stage of the bubble or bust we find ourselves in. So please check out that video. But the upshot is that when one compares house prices to rent, the red line, and income, the blue line, house prices are still well above historical norms, although there has been a slight correction. Regular viewers will know that I like to stress it's never just one thing. Super low interest rates played their part, and most Canadians are very familiar with the bottlenecks around permitting, zoning, and the NIMBYs that all work to restrict supply. However, what really sent housing and rental markets into the stratosphere was record population growth, which was driven entirely by immigration. This demographic demand massively outstripped housing starts, which led to a record supply deficit. To be crystal clear, this is not a dig at immigrants. Immigration can and should be a boon to long-term economic growth, but the dose makes the poison, and no country, anywhere, can sustain a trebling of population growth with hardly a thought as to where these newcomers will live or the infrastructure or services they require when they get here. Furthermore, population growth of this magnitude can hide, contribute to, and exacerbate more systemic issues. For example, falling productivity growth. While it's good that top line or real GDP rises, what really matters, what lifts the standard of living of working people is productivity growth, or real GDP per capita, or simply more output per unit of input. On this measure, Canada's record is terrible. One of the reasons Canada's productivity growth is so poor is because the Canadian private sector no longer invests at the rate it once did. Again, it's never just one thing, rather a confluence of the growing and cumbersome regulatory framework, high carbon and other taxes, and stiff competition from abroad. And indeed, it's Canadians themselves that are seeking greener pastures, specifically in America. And we can see that here as outward direct investment, the red line, is outpacing inward direct investment. Note that it wasn't always the case. For the sake of brevity, and there's more bad news, I assure you, I'll simply list the last few, but in no way do I want to diminish the importance and the real-world impacts of rising unemployment, rising consumer and business insolvencies, delinquency rates in the mortgage market, and stalling industrial production. The loonie is also at a 20-year low, and this is going to have material impacts on inflation and interest rates as Canada imports so many of its consumer goods. But let's switch gears. As investors, it does us no good to be moved to hysteria, good or bad. And as we've seen, the tariff situation is fluid. Although we've been keen observers of the trade war, we have resisted the temptation to present a deep dive on the tariff threat because we continue to believe that they represent a negotiating tactic. Tariffs, in our view, are a means to an end. The Trump administration is using its economic might to achieve certain policy aims, and our efforts have been centered on a dispassionate triangulation of the investment implication of those aims and how they might impact our portfolios long term. That said, there's been some interesting analysis that's been done on the trade war. The first is from the Peterson Institute of International Economics. It's a one-off inflation projection from a baseline forecast for Canada, the US, and Mexico. And as you can see, the tariffs in the short term are indeed inflationary. But what's interesting to note is that more pain comes from retaliation, which raises inflation rates even further in all three economies. Remember, tariffs are paid by the domestic consumer or importer. The second chart is from the Bank of Canada governor's most recent speech, and indeed it's a lot scarier. It suggests that economic output initially falls, then steadies, and begins to grow again, but on a path that's 2.5% lower. Let's call it a one-off shock. But Tiff Macklem, in his speech, rightly cautioned on relying too heavily on these types of forecasts. There are too many static assumptions involved, like the fact that in this model, the tariffs are permanent, and there are no carve-outs like the one we've seen today for the auto sector. The final chart in this section confirms the BOC's forecast, and again, you will note it is the retaliation that stands out. Either way, tariffs are not good for Canada or the US. But the problem, again, is putting too much stock in these forecasts. You'll note that the chart goes out 15 years, which is, in a sense, laughable. Projections that far are meaningless. Anything and everything can change in the interim. The final thought I'll leave with you today is that two things can simultaneously be true. One, Trump's methods are pig-headed and tariffs are dumb. But two, at every turn, our government has sought to inflame and aggravate rather than to de-escalate and to carve a path to an inevitable resolution given the proximity of Canada and the United States and the economic interdependence. We think the latter has been done largely for political expediency and as a cover for the major domestic issues that I've outlined. Problems whose impact may last long after Trump is gone and have lingering investment implications for Canada and Canadians. All right, so that's a wrap on this week's episode. Please like, subscribe, and follow for more. And as always, we manage money for families across Canada and the rest of the world, so feel free to get in touch.